Good morning and welcome to Member Focus Monday. I'm Christina Schaefer, Director of Social Media for HAR, and we are very pleased to be joined this morning by Patrick Jankowski, the Senior VP of Research for the Greater Houston Partnership. Welcome back to the program, Patrick.
Christina, it's always fun to be on. I always enjoy our visits, and hopefully I can share some insights that'll benefit your members.
Absolutely. We are so excited to have you, and so are our members. We're already getting comments. I look forward to hearing from Patrick every year. He's amazing. So thank you so much for joining us this year and in past years. But for anyone who hasn't heard from you before, tell us a little bit about yourself and the work you do with the Greater Houston Partnership.
Okay, I'm the Senior Vice President and the Chief Economist for the Greater Houston Partnership. I recently celebrated my 40th anniversary with the organization. I've been with it for 40 years. The role that I play is one as Chief Economist, but I also lead the research team. And the research we do, we support the program of the Greater Houston Partnership, the mission, where we're trying to go out and recruit businesses to the region. We advocate on behalf of policies in Austin and Washington that are favorable. We welcome trade missions. We do all sorts of things to basically try to make Houston a better place to live, work, and grow a business. And the research team provides the data the organization needs to do that.
Excellent. Well, thank you. And thank you for that work you do, because we know how important it is to bring those businesses to Houston. Let's jump right into it. You just recently gave your update. So we're happy to have some fresh data from you. What is the overall status of the Houston economy?
Houston economy is doing well, but it is slowing down. I mean, we have been going at such a rapid pace the last 3 years. We just couldn't maintain that pace indefinitely. I mean, we've been sprinting, and we need to stop and catch our breath. So we are seeing a slowdown in Houston's economy. We're seeing slower growth, but I want to be real specific about this. We're not seeing a recession. We're not seeing a collapse in growth. We're simply seeing growth slow down to a more sustainable pace. The last 12 months, the region's created about 57,000 jobs, which is pretty good. Through October, 57,000 jobs. But compared to October of last year, we created 122,000. Through October 21, 133,000. So you can see we're definitely slowing, but that 57,000, that's maybe about normal, maybe a little bit faster than normal, and we're going to slow down next year, maybe a little bit more closer to normal. We'll probably finish up the year somewhere between 70 and 80,000 jobs. Anytime we do more than 70,000 jobs, it's a good year for Houston.
That's great. So what about the national economy? What's the overall status there?
National economy reflects Houston, and Houston reflects the national economy. We're seeing a slowdown nationally as well, but we're still seeing healthy growth. We're still seeing growth. The jobs report came out on Friday, created 199,000 jobs. Some of the pundits bemoan that it's less than we had created earlier in the year, but the long-term average, if you look at the 10 years prior to the pandemic, the U.S. created on average 200,000 jobs. So 199,000 were right there at the long-term average. The unemployment rate dropped. I'm going to have to look down at a number. The unemployment rate dropped. Oh, I'm looking for it. I did not write the number down, but I do know the unemployment rate dropped in November. We're seeing GDP growth has slowed down just a little bit. But one of the numbers out there you want to follow is the initial claims for unemployment benefits. Now that's a sign that people are getting laid off. 4-week average has been averaging about 220,000 initial claims for unemployment benefits. That's pretty close to the long-term average. 220,000 may seem like a lot of claims for unemployment benefits, but that's 0.15% of all jobs out there. So it's less than 0.2% of all jobs out there. So the U.S. is still doing well, but like Houston, it is slowing.
Okay. So again, after those most recent job numbers, many have said it looks like we will now have a soft landing for the economy. So what does that mean?
Well, we are going to have a soft landing. If you think about it, this time last year, there were a lot of economists out there who were worried that we'd have a recession in 2023. Hopefully you remember I came on, I said, no, I thought it was pretty clear that we were not going to have one. And here we are in December. We yet to see that recession so many predicted. We're going to see slower growth. We're going to see slower job growth. We're going to see slower GDP growth. But once again, what we're trying to do is find a sustainable pace. Coming out of the pandemic, We had a bit of a sugar rush when the federal government injected all this money into the economy. You know, we suffered a little bit from cabin fever. We had to stay home. We were told, stay home, isolate, don't go out. When we finally allowed to go out, we spent like crazy. Uh, and so the sugar rush, and also just a little bit of a boomerang effect, or because we shed so many jobs in March and April, and when we finally opened up, we started adding them back. Those factors aren't present anymore. The sugar rush is gone. The cabin fever is over with. We're back to a more sustainable level of growth. The danger is that everyone is going to look back at the last 2 years and think that's normal, and it's not. What you need to realize is the last 2 years were an aberration. And so what you need to compare the growth that we're seeing in 23 and what we will see in 24 to more like what we saw in 17, 18, and 19. And if you look at where we are now compared to where we were prior to the pandemic, we're doing pretty well. We're actually doing a little bit better than pretty well.
Okay, wonderful. If you are tuned in live and you have questions for Patrick, please type those in and we will get to as many as we can. Of course, I have a lot more questions for you that I have written down here, Patrick. Starting with, let's get a little more specific into Houston's economy. What sectors of Houston's economy do you see growing in 2024?
We're going to see almost every sector, but about 4 or 5. And we're going to see growth in restaurants. We're going to see growth in retail. We'll see growth in professional services. We'll see growth in healthcare. We'll see growth in education. We'll see growth in manufacturing. We'll see growth in arts and entertainment. The sectors that aren't going to grow are the ones which are most impacted by the high interest rates and the fact that we overbuilt somewhat in construction. Finance and insurance is going to struggle. We're already seeing some layoffs in those sectors. Construction is going to struggle, and so is real estate, both residential and commercial. We've got on one hand, what we have is projects which were financed when interest rates are very low, and they come up for refinancing, and they can't pencil it out at the higher interest rates. We may see some properties go back to the banks, or properties go back to the lenders. And if you have properties which are going into foreclosure, you're less likely to be building things, or the banks are going to be reluctant to loan money if they're worried that they're going to be taking projects back. And then you've got the high interest rates, as everyone out there knows, the impact that it's been having on home sales.
Mm-hmm. Okay. Are there any other sectors that you're closely monitoring as we go into 2024?
I am looking at energy as well. And energy is not the driver that it had been in the past. If you look at the last time we had a downturn, which was the Great Recession, and we had that wonderful Eagle Ford shale boom, and that helped lift Houston out of the recession. Mm-hmm. We have not seen energy providing that sort of lift to us. It's not going to be a drag, but it's not going to provide the sort of lift. We're going to see a little bit of a growth in production, domestic oil production. That's going to help somewhat. Oil prices will probably average about $10 higher than they're averaging now. That will help somewhat, but they're also dealing with higher costs. You're going to continue to see consolidations. I saw the headline. I didn't catch the exact company, but Oxy is acquiring a company. Chevron is acquiring a company. Exxon's acquiring a company. What I've seen in my 40 years of watching Houston's economy, watching the energy industry, is whenever the energy industry consolidates, it consolidates into Houston. And so we'll have a little bit of benefit from that. Plus, we are seeing some movement in the energy transition. We're not seeing the huge job numbers and the huge investments that we'd like to see, but we are seeing some growth there. If you're going to go drill a well in the middle of the Gulf of Mexico, you're going to spend $10 billion, and you're going to spend that over 5 or 7 years. If you're going to put up a solar array, a solar farm, you might spend $100 million and do that over 6 months. So it's not the same sort of scale as traditional energy, but we are starting to see some areas that we're seeing some growth. I mean, here at the partnership, we've been trying to identify companies which are somehow engaged in the energy transition. And we actually have come up with a list of about 500 companies that we've actually vetted. We've gone to the websites, we've read through their descriptions, that are somehow engaged in the energy transition. Some are traditional companies like Chevron and Exxon. And some are more obscure companies, but they're somehow engaged in trying to get us to that zero carbon future.
Okay. So the sectors that you mentioned, and there were several that you anticipate growth in 2024. I believe you said education and others. What is in restaurants? What is driving all that growth?
Okay, every sector has a different driver. One of the things that Houston is still benefiting from is population growth.
Mm.
We ranked second in the U.S. last year in population growth, second to Dallas, ranked first. That population growth has multiple components to it. One thing is last year, every year people move into the region and people move out. And what you want is on a net to have more people moving in.
Mm.
Prior to last year, the years before, 17, 18, 19, 20, 21, net in migration, people moving into the region was only about 40,000 people. Last year, it was around 84,000 people.
Oh.
And so any sector which benefits from population growth, which we're having, should grow. Also, we have, in a typical year, we have roughly 94,000 babies born, 95,000 babies born. That's going to help very much with healthcare, because if you think of all the times from birth until they go off to college, all the times you're taking your child to the doctor, or all the times for the stitches or the broken legs, excuse me, or the sort of things that happen when you're growing up. So that's going to support healthcare.
Mm-hmm.
And plus, every year, about 32,000 people reach the age of 65. And as you get older, you tend to go visit the doctor more often.
Mm.
So that's going to support healthcare. So that sort of population growth supports healthcare. When people move into the region, when they buy houses, there's usually always retail that goes up in the neighborhood. Sometimes it's a huge Walmart or an HEB or a Kroger or a Randall's. Sometimes it's small, but that supports retail. And there's little restaurants that grow up in the neighborhood that supports restaurants. So one of the big drivers for consumer-oriented sectors is going to be the fact that we're still having people move here.
Okay.
Other sectors, it's a little bit different. For manufacturing, we'll probably see a little bit of an uptick in the oil and gas industry next year. That'll feed a little bit into the building of rigs and everything that goes to the rigs. If you look at the American Chemistry Council, they're expecting to see exports of chemicals pick up next year. That should benefit the industries along the ship channel. The World Trade Organization, the WTO, they are forecasting trade to drop down to maybe a growth of only 0.2 or 0.3% this year, but to get back up to maybe 0.3%. So world trade grows, that should help Houston. One of the things we've been dealing with, if you think about it, coming out of the pandemic, there was all these supply chain issues. And so retailers and manufacturers and wholesalers, they overordered. They're worried that they weren't going to be able to get enough to meet their customers' needs. So they ordered more than they needed. They went from what used to be a just-in-time frame of mind to just in case. And then when retail sales started slowing down or other activities started slowing, they found themselves with these warehouses which were bulging. Mm. And so what they had to do is start destocking their inventories. They had to start selling out of their warehouse, selling off their shelves. And so they stopped ordering as many goods. And so if you stop ordering many goods, that means there's less manufacturing activity. It means there's less transportation activity to get the stuff from the factory to the warehouse. There's less activity in the warehouse. You're not expanding your warehouse or your wholesale trade. Mm. So, the fact that we've kind of finished with destocking will help. So all sorts of different factors. Education is going to benefit from the fact that we have so many young people. We're still adding a lot of young people to the population. So overall, the economy is doing fairly well. If it wasn't for what's going to be happening in commercial real estate and somewhat residential real estate, what's happening with interest rates, job growth would be a lot stronger. It's just those sectors are actually going to be a negative and subtract from overall job growth next year.
So let's really get into the housing market, because as you know, that's important to us at HAR. How do you believe that the Houston housing market will be impacted by all of these shifts that you've mentioned from other sectors, but as well as interest rates?
Okay, first I have to have a sip of Earl Grey. Excuse me, after I talk for so long, my vocal cords get a little bit dry. Okay, so these shifts affecting housing. One of the things I want to talk about is I've looked at the data that the Houston Association of Realtors provides and looked at median home prices. And it looks like we may be hitting a point to where home prices may have stabilized. If you look at what a home sold for this October versus last October, and I've got that number somewhere, if I can remember. Here you go. So I have to look down at my notes. Median price single family home in Houston this October was $327,000. Median price 327. October last year it was 330,000. So it's actually dropped $3,000. If you go back to October the year before, 2020, it was 305.
Mm-hmm.
So we went from a time where we were seeing double-digit increases on a year-over-year basis in home prices to where actually we're starting to see a slight slippage in prices.
Mm-hmm.
So that should help somewhat the fact that there's some stability in home prices. We have seen a little bit of a dip in interest rates. They peaked around 7.8%, 30-year rate, conventional mortgage around 7.8%. The last data I looked at, interest rates were about 7%. So hopefully that means housing will become a little bit more affordable. It's still not as affordable as it was 2 or 3 years ago. HAR, you guys did your own study, the house affordability study.
Mm-hmm.
If you looked at the first quarter of 2021, roughly 60% of all households in Houston could afford the median priced home. If you looked at it in the third quarter of this year, it's only about 38%. I'm hoping with interest rates slipping a little bit and home prices stabilize, we'll be able to sustain some level of housing demand. The fact that job growth is going to slow may pull down a little bit from that, but job growth is slowing at the same time that home prices are stabilizing and interest rates have slipped a little bit, so maybe they'll offset the two. We'll still have people moving here, and that's going to be a big plus for the housing market.
Mm-hmm.
We were at one time we were selling at an annual basis 110,000 single family homes a year. We're not going to get back to that. We're going to probably see ourselves finish up this year somewhere between 80, 85,000 single family homes. And next year it'll probably be in the same range, maybe a little bit less. Because things are slowing down. We just can't sustain that pace that we've sustained over the last few years. I kind of liken it to the Olympic sprinter Usain Bolt. I don't know if you guys remember Usain Bolt, the great gold medalist who won medals in the 100-yard dash and the 200-yard. And everybody knows Usain Bolt because he was the fastest man on earth. But he was fast over a very short distance. And you wouldn't see Usain Bolt running a marathon. He just couldn't do it. And,
Yeah.
and growth is not a sprint. The next few years, it's going to be more like that great marathoner, Eliud Kipchoge. God, did I pronounce it right? He's won 5 of the last 6 marathons he's entered, and his secret is he finds a pace that he can sustain over the long run. And that's what we're trying to do in Houston. That's what we're trying to do with the U.S. We're trying to find a rate that we can sustain over the long run. So if you look at next year's numbers and this year's numbers and you say, gosh, we're down because we're trying to find what's normal. 2021 and 2022 were not normal.
Yeah. And I think that's a really great perspective for our members to hear and to also be able to share with their clients and customers that it's more about that long-term finding that stability as you're mentioning. Let's talk a little bit about the mortgage or the interest rates, because we know that is a very hot topic. Economists seem to have quite divergent views of what the Federal Reserve may do in 2024, but most seem to think there will be 2 to 4 interest rate reductions. What are your thoughts?
I'll let you know I'm in the minority. Actually, I disagree very much with most of the economists out there. I don't see interest rates falling very much at all next year, if at all. The Fed, interest rates are dictated by the Fed, the Open Market Committee. And those follow through to 10-year treasuries and follow the 30-year interest rates on mortgages and so forth. The Fed has a dual mandate. The Fed is tasked by Congress with 2 things. One is full employment, and the other is stable prices. Now, we're pretty much at full employment with an unemployment rate well below 4%. We're still creating 200,000 jobs. If you look at that data, the JOLTS data, job opening and labor turnover survey data, there's still 8.7 million job openings in the U.S. The long-term average is about 6.4. We are at stable employment. So the Fed has reached half its mandate. The other half is stable prices. And we hear about headline inflation, we hear about the CPI, and it's a little bit above 3%. It's not the consumer price index that the Fed tracks. It's something called Personal Consumption Expenditures Index. It's PCE. And it's not just that, it's something called core PCE. It doesn't get reported widely in the media, but the Fed wants core PCE, personal consumption expenditures, once you take out energy, once you take out food, to track at 2%. In October, the core PCE was at 3.5%. So we still have a ways for the Fed to go to get down to their 2%. Now, they'll probably pause on raising interest rates and sit back and want to see what's going to be tracking. But the Fed is not interested in the stock market. It's not interested in financial markets. The Fed is interested in stable prices and full employment. Now, the stock market may eventually play to that, but they're going to be watching right now that core PC more than anything else. Now, if the Fed's going to lower interest rates, it probably wouldn't be till after mid-year, and then you're not going to see a dramatic drop in interest rates. They're dropping by 25 basis points, by 2.5%, and so if you're waiting for interest rates to fall precipitously, don't hold your breath. I mean, you'll turn blue before interest rates get down as low as you'd probably like to see them.
Okay. We had a question that came in from Demetria because you mentioned people moving to the Houston area. Why are people moving to Houston? And will that demand cause an increase in rental and purchase prices?
People move to the region for a number of reasons. The most important reason, the biggest reason is economic opportunity. It could be that they've been offered a job, or it could be that they look at Houston's economy and they realize it's strong enough that if they move here, they can find a job. Some of them move here for cost of living. They cannot afford a home on the East Coast or the West Coast, so they figure out they'd move to Houston because homes are more affordable here. You get people who move here because they want to be closer to family. And frankly, if you have snow 3 months out of the year or 6 months out of the year, you get people who move here. We like to joke at the partnership. You know what we do in January? We shovel sunshine. I mean, look outside today. Look what a beautiful day today is. This should be a postcard sent to everybody who lives up in the Northeast. And so that's one of the main reasons why people move here. As far as the impact on home prices and the impact on rents, right now, we're probably going to see home prices, as I said, stable. You'd have to see a huge surge in migration to put upward pressure on prices. I don't see that. If you look at rents, I want to look at it in two different ways. You've got the rent of single family homes and you've got the rent of apartments. When I looked at the HAR data, single family home, the average rent is about $2,300 a month. A brand new Class A apartment, think about a brand new apartment, average rent's about $1,600 a month. So you're looking at a $600 to $700 differential between moving to a brand new Class A apartment or renting an existing house. Some people are going to prefer, I want to be in a house, but people are going to say, an apartment unit that's only a month old and it's got a swimming pool and a gym and they have parties and all sorts of cool stuff. So you get people who are renting just because they can't afford to buy a house. Mm-hmm. And the problem with the multifamily market is we're still overbuilding. Last year, we added about 25,000 Class A apartments to the Houston market. We only absorbed about 15,000. So that meant there were 10,000 units out there that didn't go leased. And we're seeing apartment rents for Class A drop. Right now, there are about 22,000 apartment units under construction. You're not going to see all those leased, especially as we see the job growth start to slip. And so you're going to continue to see more Class A apartments come on the market. That's going to put downward pressure on Class A rents, which means consumers are going to have this choice. Do I want a brand new Class A apartment at $1,600, $1,700 a month, or do I want to rent a house at $2,300, $2,400 a month? Now, some for lifestyle are going to want the house. Some will say, I'll rent the apartment and I'll take that extra $600 or $700 a month and have fun with it.
Mm-hmm. Yeah, that makes sense. Another question came in from Carlos. He said, how are the wars in the world and frictions with China affecting us here locally?
Oh, that's a big question to unpack. You know, it's a shame all this is going on. It
Mhm.
really is. I worry about the Ukraine. You know, they've held out for what going on 2 years, almost 3 years now,
Mhm.
and I think there's some exhaustion with being able to support some exhaustion from the West being able to support them. Uh, I think we have managed to somehow absorb the impact on supply chains and the impact on crude. Um, so if you look at Gaza and you look at Israel and Hamas, um, and it's just it's upsetting from a personal thing. It's not had a material impact on the economy yet. If we saw one more conflict,
Mhm.
uh, it's at some point you just worry things are going to get out of hand. So as far as their impact on the overall markets, they haven't impacted them significantly yet. Two or three more hotspots flare up, and it could definitely impact the U.S. economy, impact the world economy.
Okay. Thank you for that answer. So you mentioned earlier really the need for home prices to stabilize. When do you think we might see home prices stabilize?
Well, I think they are now. As I said, when I looked at the median price for a single family home, we've not seen very much movement in them over the last 12 months.
Hmm.
They've wiggled a little bit, but if you go back 2 years, we were seeing the median price going up at a double digit rate. There was one month where the median price of the single family home was 18% above the same month the prior year. Now we're seeing the rate of increase either being 1% or 2%, or actually being slightly negative. I think the median price for single family homes has stabilized. Uh, as far as new homes, the builders are trying to do everything they can to keep those houses affordable. They offer all sorts of incentives, and they buy down points and so forth. I think we're as far as stabilized in the sense that we're not going to see an escalation in prices. We might see a get back to where we see a 2 to 3% increase on an annual basis. But I think we're for now, for like the next 6 months or whatever, we're not going to see them go up double digit rates, even in the low single digit, even in the high single digit rates. We're going to see any sort of appreciation would be in the low single digits.
Okay. Well, with the current state of the market, what is your advice for for home sellers, and what is your advice for home buyers?
Home buyers is the easiest one to talk about. I mean, I get people that ask me all the time, is this a good time to buy a house? And I think I said this the last time I was on the program. If you find a house that you're in love with, that's the right time to buy a house. If you find a neighborhood that you're in love with, that's the right time to buy a house. If you try to wait so long and you try to time it on interest rates or time it on prices, you're going to miss out on the place that you really want to live. And so if you find the house that you like, just somehow bite the bullet, make the numbers work, and sign that contract. For sellers, you're past the point where you're going to see significant appreciation in the house. If you're looking for significant appreciation, you've achieved it, and now's the time to sell. The issue is, as we've all heard, is you're going to have to buy something else, and you're going to have to buy it at a 7% interest rate.
Hmm.
But as far as expecting significant appreciation in your home and trying to capture some additional capital gains, uh, it's time to lock them in now, because we're not going to see significant appreciation for a while yet.
Okay. Along that same vein, Monique is saying, how does this market look for investors?
Oh, that's something I'm not real comfortable asking, because I don't know. For every investor, it looks different. I don't know what their portfolio looks like. I don't know what
Hmm.
their long term objective is, and so forth.
Okay, very good. Well, Patrick, we're getting close to the end of our time here with you. But again, we always appreciate you taking time for us and giving us an update. We really look forward to this from you. Is there anything else that you want to share with our audience today?
I just want to emphasize the message. Things are going to look slow going forward, but it's going to look slow relative to how it looked coming out of the pandemic.
Mm.
Slow growth does not mean we're in a recession. Slow growth simply means we're moving back to a more normal pace. If all Houston did was add 60,000 jobs a year going forward, a decade from now, we'll have 600,000 more jobs. So, slow growth, and it's more sustainable. It allows us to catch our breath, maybe make some of the improvements, the infrastructure we need to make. So don't worry about things being slow. Slow is actually good. It allows you to plan and fix things.
Very good. Well, Patrick, people are thanking you. Great insight. We have a comment that just came in that says that. How can people keep up? We did put Houston.org in the comments. How can they keep up with you, and how can they sign up for your Economy at a Glance newsletter?
A couple things. The partnership's website, Houston.org, we post the newsletter there every month. If you open up the newsletter, at the very end of the newsletter, you can click on the link to email and ask to sign up for it. Mm-hmm. Also, if you go to Houston.org and you look for me, Patrick Jankowski, the chief economist, you can send me an email from the website and let me know. Okay. Or I'll give you my email address right now. It's my first initial, my last name, P. Jankowski at Houston.org. And just send me an email and I'll go ahead and I'll get you signed up. I mean, we want the information out there because we want people to make well-informed decisions. If they make a well-informed decision, they're less likely to make a good decision. They're more likely to make a good decision.
Well, thank you. And again, our audience is thanking you in the comments. Really great info. Thanks a bunch. Thank you for the valuable information this morning. And of course, we always thank you for taking time and making time for HAR. And we did share all of that information in the comments as well. So if you're looking to get in touch with Patrick, you have his information in the comments. And thank you for being so accessible to our members as well. We truly appreciate that.
Sure. Well, I like talking to you guys. And I was at a party Saturday night and ran into a friend who's a realtor. Hopefully she's listening. And we talked real estate for about 30 minutes. It's always fun.
Very good. Well, thank you again for your time today, Patrick. Before we go, I do want to let everyone know to save the date for next Monday. We will be joined by HAR President and CEO Bob Hale for our final Member Focus Monday of the year. So be sure to tune in next Monday at 9 a.m. Have a great week, everyone. Bye-bye.